pick out your pen and paper. I will warn, well, why don't we go ahead and get started. Yalnimdas, everyone. My name is Ali Kandaya, and I wanted to officially welcome you to tonight's webinar, Retirement Accumulation and Distribution Strategies. This is an initiative of the AGCON Planning Board. Accordingly, I wanted to quickly introduce Chairman of the AGCON Economic Planning Board for the United States, Akbar Punawala. He's going to just share a few words with us before we kick off the webinar. Chairman?
Yes, thank you, Likan. Yalimidat, everybody, and thank you for joining on a weeknight. This what we consider to be a very important webinar on a particularly important topic: retirement accumulation and distribution strategies. I guess this is a topic that has been around for a very long time, but it has taken on a higher level of importance in recent days, recent months, years, for a variety of reasons. One is because lifespans have grown quite dramatically with advances in sciences and medical sciences and so on. So people live to be 80, 90, 100 years of age, and perhaps even longer as we move forward in medical discovery. And as human longevity goes up to 80, 90, 100 years, how much time we will be spending in retirement also becomes a large portion of the total life lived. So it is a known fact, it's a common statistic, that the most amount of money that humans spend are in the last and final years of life in supporting the quality of life of the human being. So whether it is in a retirement home or whether it is seeking medical help, assistance, medical support, etc., the amount of resources required to keep us going in the latter part of life that is very demanding on a person's resources. So that's one reason, longevity and the situation that it creates, that we have to provide for the 20, 30, 40 years of retirement, which is a much longer span of time than our forebears had. So that's something that we have to take into account. The second and major issue why this has become important is because of the fraying of the social safety net, whether there will be a social security system that we can count on when a person retires. You're a 20-year-old person, you know, by the time you retire, the retirement age could be 75, who knows what it might be. And then one might spend 20, 30 years in retirement. How much will Social Security be able to cover? Right now, that is not very clear. So it makes sense for us to put in place some measures that will allow us to take care of our later years in life and to provide for a good quality of life, which is what the Imam would like for us, which is what we would want for ourselves. And those are the two key points that are the driving factors behind retirement accumulation, that longevity is causing longer lifespans, longer retirement age, and nobody is going to give us any loans for retirement. When we are in the earning years of life, we can borrow for our business, we can borrow for certain things, even vacations, but in retirement, nobody's going to pay us or give us a loan for a retirement loan. So that's something we need to take into account. We'll have to conserve our resources in our earning years for such time as when we need it to be decumulated. So we have to pull it back in our later years from our retirement savings. So retirement savings has been important for a long time, but there's never been a time when it's more important than now, especially in this current context where the social safety net is fraying and the lifespans are increasing. So I think that point's well made. The other point would like to talk about is the fact that the Economic Planning Board has been monitoring the Jamaat's savings habits to the extent that it can, as becomes known to EPB, and it, it appears that the savings for retirement, savings for college, for children, etc., has not been that much of a priority for people, because there's always a tomorrow. There is always, I'll save more when I make more money. So I think there is more of a tendency, the consumption economy that we have in the U.S. That's part of the reason. There could be other factors as well, but the professionals in the Jamaat, be they millennials, mid-stage, or later stage professionals, it's very easy for us to go ahead and sign up for a 401k plan at work, or sign up or invest in an IRA. There are numerous methods which we will go through in this webinar, which will talk about strategies to save and accumulate for our later years in life. So we should, and there are tax advantageous ways. That's another reason why we should be saving, so that we can make the most of that tax advantage. So those are some of the reasons, but let's be guided by the accounting and the financial professionals who are going to be conducting this webinar to tell us how best can we save for our retirement. But saving is a must. So that's something we must take away. The Imam has pointed this out on numerous occasions to the US institutional leadership. More recently, in 2015, Maulana Bapa talked about the financial planning to the then National Council leadership, and said, and he said to the effect that, you say that the financial planning is not part of a family philosophy, but it should be. And then he went on to say that that's probably the reason that is the case, he said, is because of the segmentation of the Jamaat. So the Imam guided the National Council and the EPB at that time to segment the Jamaat and to speak to the Jamaat in a very segmented manner. So this webinar today is an attempt in that direction. This is to segment the professional segment of the Jamaat, to segment that horizontal of the Jamaat, and to speak to that audience and say, how can we speak to this audience and come up with strategies that are relevant and pertinent to this segment of the audience. So please understand that aspect, the tonality, the emphasis that the Imam has placed on the need for financial planning. And he said it should be part of a family philosophy. Lastly, I would say that the Economic Planning Board conducts this in February. February is announced as and observed as a retirement savings month across the US. We've shared this information with the Imam as well. Imam was supportive of that. And we've got a partnership going on with Charles Schwab to set up IRA accounts. The team will talk about that. But irrespective of whether you save through an IRA, through a workplace 401k, or through the Charles Schwab channel that the EPB has helped establish for the Jamaat, the point is that we must save. We must open those accounts, we must save. And not only should we save on a one-time basis, not only is it adequate for us to start an account, but it's most important to fund that account on an annual basis. So the February month is a reminder that we ought to be saving for retirement. We need to be contributing. So sometimes people get bonuses from work, sometimes you get tax refunds from your tax filings. So February is a good time before the tax filing date of April 15th, where we kind of say, let's keep in mind that not only do we have a savings plan for retirement, but also we need to fund it. So our request to you would be to keep this in mind and kindly provide for your retirement, save for the rainy day. And I hope everybody's doing that, and I wish you well as you look forward to creating that safety net for the later years in life. Thank you very much for joining. hand you over to Ali Kandaya.
Thank you, Chairman. Very inspiring words, and I think that fits so nicely with what we're going to dive into with tonight's session. However, before we do, as everyone knows, just to officially state, the institutions do not endorse, recommend, or promote any individuals or products. The information that we're presenting tonight in this webinar is for educational purposes only. We aren't going to provide any specific advice to any individual's situation tonight. So even as we go through the Q&A, we will try our best to answer as many as we can. But for anyone who's seeking individual advice on their specific situation, we encourage you to please consult with your investment professional for advice specific to your needs, your objectives, and your circumstances. With that, you will have an opportunity, just from a housekeeping perspective, to ask questions through the Zoom Q&A feature throughout the portion of the webinar. We are going to have a little bit of time at the end, again, to address as many questions as we can. If there are natural places within the webinar for us to answer some questions, we will do that as well. And we also have a team standing by to respond to questions in real time through that Q&A feature in Zoom as well. So hopefully everyone feels like their questions are getting answered. But again, just to reiterate, anyone who's seeking specific investment advice to your specific situation, we highly recommend that you actually go and speak to an investment professional. If you don't have an investment professional, stay tuned to the end of the webinar. We do have an email address at the end that you can send and have somebody from EPB help facilitate you getting connected with a financial professional. So with that, let's go ahead and quickly dive in here. So you've probably noticed two familiar faces if you've been on any of our previous Money Matters series, Aliyah Padamsi from Fidelity and Ismet Kimani from Merrill Lynch. Again, I'm Ali Kandaya. Just for those who I haven't had a chance to meet yet, I serve as the Managing Director of Innovation and New Product Development at Charles Schwab, responsible for a lot of our new product launches that you see at the firm. Aliyah, if you could just quickly introduce yourself for the audience.
Sure. Yali Madad, everyone. So happy you're here. I'm Aliyah Padamsi, and I've been at Fidelity for about 7 years on a team that specializes in creating financial planning methodology for the firm. Everything we do is for the purpose of digitizing personalized and proactive financial planning guidance at scale to provide customers with their next best action steps to achieve holistic financial wellness.
Fantastic. Happy to have you back, Aliyah. Isma, can you tell us a little bit about you?
Sure. Thank you, Kandi Ali Khan. Yali Madad, everyone. Thanks for joining. I'm Isma Jafar Kimani. Over the last 23 years, I have been blessed to have the opportunity to work as a wealth management advisor and a portfolio manager with Merrill Lynch in the western suburbs of Chicago. My practice primarily focuses on estate planning for high net worth individuals, as well as wealth management, financial planning, and retirement planning for business owners and individuals. I focus on both sides of the balance sheets for my clients, such as their assets, as well as their liabilities, such as their mortgages, commercial loans, or any type of loan that they may have outstanding. I would like to express my gratitude at this time to this team for their excellent work to put this presentation together. And I want to express my gratitude for allowing me the opportunity to serve the Jamaat. Thank you.
Excellent. So now that we've had a chance to meet everybody, I wanted to, before we kind of go further, just make sure everyone's kind of clear on what you're going to take out of today's session. So for those who joined at the very top of the hour, you probably heard me say that you're going to want a pen and paper for tonight's session. But here are the kind of big core questions that we're hoping everyone walks away being able to at least start answering for themselves. First is, how much do I actually need to live in retirement? So we heard Chairman Akbar share with us just that longevity is increasing in retirement, and that the expenses, the amount of money that's being spent in those latter years of your life are increasing as well. Secondly, what are the different types of income sources that you could have in retirement? So you already heard a couple of the buzzwords for tonight. You heard Social Security, you heard IRA, maybe you heard 401k as well. The good news is that's only a handful of the tools. There are others as well, and we'll cover all of those tonight. The third question is probably the one that's on top of mind for a lot of folks, particularly over the last year with the pandemic and the associated market volatility that we've seen, which is, am I on track for my goals for retirement? And as you've probably heard about us talking in previous Money Matter sessions, the concept of goals is really important here. Anytime that you hear the term financial planning, generally within the same sentence, you're going to hear the concept of goals. So we'll talk about that too. The fourth topic for tonight is more on 401k and how you can leverage a 401k plan to help you prepare for that retirement and achieve that retirement goal. And then lastly, the first four questions are really focused on the accumulation going into retirement, but what about when you're actually in retirement? And so we also wanted to spend a few minutes talking about drawdown strategies or distribution strategies during the retirement portion of your life. Before we kind of go into any of those topics, one last thing, it's quiz time. So I'm going to go ahead and ask our team to launch the survey. I'm going to see the survey launch for you, and in real time, you'll also see it shown up on your screen here. The question, and I'll read it out loud one time, and then take a moment, go ahead and respond. In November of 2020, so just a few months ago, 80% of respondents cited which of the following would relieve a significant amount of stress in their lives. And we'll just give a moment for everyone to respond here. And we've got about 2/3 of the audience has responded. We'll just give it another 10 seconds. Excellent. So we've got, with about 80% of the group responding, the good news is most of you got the right answer, which is getting their finances in order. And it's really interesting to see that, out of these three things, given that we're in the midst of a pandemic, in the midst of all of this market volatility, unemployment hovering around 10%, getting finances in order is one of the top relievers of stress. And so I can't thank all of you enough for being on with us this evening. Hopefully at the end of this, you'll also be able to start to see some of your stress around your finances go down as you start coming up with a plan and taking advantage of benefits that may already be available to you. So with that, we'll dive into our first panelist question for tonight, which is, as I mentioned earlier, how much does an individual even need to live in retirement? And Hsas, just based on your background and just the wealth of conversations you've had with your clients over the last couple of decades on this, I was hoping you might be able to share with us how you think about this and how you approach this.
Sure, thank you, Ali Khan. So they are in the midst of pandemic, people are staying home with their extra time. The fourth most Googled topic is retirement planning. Number one being COVID, number two being vaccinations, number three being estate planning, and number four is retirement planning. So planning for retirement is not an easy task, especially when you're just young and starting out. Sometimes people don't think 30 or 40 years out, but people don't plan to fail, they fail to plan. So clearly define, when thinking of retirement, clearly define 3 to 4 goals for your golden years and prepare a budget with your family and your CPA and your financial planner. Someone that understands your goals, understands your value system. So for example, a lot of times I'll hear that my number one goal from my clients, I would hear that they don't want to outlive their retirement assets. So let's say if they've saved $1 million, which seems like to be a lot of money right now, and they're in their 50s, but they choose to retire in their 70s. Well, by that time, inflation has kicked in and a gallon of milk is no longer $3, it may be $5. So they are afraid that they may outlive their retirement assets, especially like Chairman Saib said, that if someone is living and they have longevity and they live to be 100, so when they're 70, they could easily live 30 years into retirement. Number 2 goal could be, they want to have enough income not to want to have to change their lifestyle. So when they quit their job and they're staying at home, maybe they're used to traveling and they don't want to not travel anymore, especially if they're in good health. Maybe they want to take up a hobby, and all of that will cost extra money. So as you're planning, plan for all of that and plan early, whether you're 20, 25, 30, 35, it's never too early to start planning for retirement. At the same token, it's never too late to plan. So you may be in your 50s or 60s, it's not too late to plan for the retirement. So I would start with saying that just define a couple of goals and then start with one thing at a time with the professional. And then I would say that a person usually, when you're budgeting for your retirement, what you want to think about is when you're working, an individual or a couple, when they're working, they may be using all of their income and they're thinking, well, how can I save for retirement? Or how do I budget? Because if I'm making, my wife and I are making $100,000, we're spending all of it. But remember, when you are young and have a young family, you may be taking care of your children, you're maybe taking care of your parents' expenses. You have medical insurance if you're under 65 years of age. You're contributing to your 401k or some type of an IRA. When you're in retirement post 65, none of those expenses will be there, right? So you're not going to have a medical insurance expense. You will no longer be contributing to your 401k or IRA. You will no longer be helping your children. They will be grown and gone. And, if you're, and plus your tax bracket may be higher when you're, pre-65, when you're working. So you may be only needing 60% of your current income. And if you take on expensive hobbies or travel to, nice places, you may be using as much as 90% of your income. But there's not a single answer that we can give you that it would be 50% or 75% or 90%. It's very customized, and only you can decide, how much that budget will be. So it's better to start planning ahead and thinking ahead as to how you want to, budget for retirement. So the best way to estimate is to pretend living in retirement. And maybe when you're 30 or 40, that may be hard to do, because of kids and such. But when you're in your 50s, and especially as you're getting closer to 60 and 65, you may want to have a rehearsal as far as 2 to 3 years prior to retirement. And the biggest mistakes I have seen people is they will come to me after they have quit their job or after they have sold their business. So please discuss this with your family first, sit down with the professional and rehearse. If you're thinking about retiring, say 3 years from now, just plan out a budget and say, I think I can live on 70,000, and then live on that 70,000 or live on that 50,000. If you cannot do it, it may be hard because you're not used to, doing that. So then take a break, tweak the numbers, and then come up with a different number, and then try it for 3 to 6 months. But please, my request would be never to quit or sell your business or quit your job. The other point we want to make is to make sure that you're meeting with the SSI, Social Security Income Benefit, review that, and have a meeting with them, find out when it may be best for you to collect, because whatever the working spouse collects, their spouse collects half of that, especially if it's a non-working spouse, or after the person's working spouse's death, the spouse, if they have been married for 9 months, they could 9 months or more, they could collect 100% of that spousal benefit. So it's crucial to have your Social Security income benefit as part of your budget for income. This would be listed on the next slide. We want you to visit, if you can please go to the next slide. We would prefer that you go to ssa.gov, because in that, on that website, there is a place where you could set up an account in which it will ask you your Social Security number, you create a password. They used to send out a Social Security statement in the previous years, but now they don't do that, perhaps to cut down the cost, which is understandable, and save some trees. So if you can go in, anybody can go in at any time. and they can look up what their benefit would be, even if they're not working, but they're married to someone who is working and paying into Social Security.
Awesome. Thank you, Isma. So three-step process to really understand what your cost of living in retirement, or really kind of defining that retirement goal, right? So one is just identifying the attributes of that goal itself. Second is calculating how you're gonna how much that amount is going to be for you, and to your point, that's very individual. And then creating a budget around that, right? That ties in and connects those goals with the amounts. And then it sounds like the kind of big tip for what I'm hearing you say is to try, if you have a chance, to test out that budget while you're still working, right? Before you actually are in retirement. Fantastic. So with that, I think it's time for another quiz. And the team is going to go ahead and launch a survey in real time while I pop this up on the slide. But I'll go ahead and read this to you once and then give everyone a moment to respond. But now that we just kind of talked through retirement goals, we wanted to just ask the audience what they think the average household led by a retiree makes annually before taxes. All right, we'll give you guys another 10 seconds here to respond. Fantastic. So this audience is very well researched, you guys. I'm going to expect some really good questions at the end of this. But the answer, as looks like 60% of you guessed correctly, is 48,000. And that's, telling, right? I think it's just important for us to kind of keep that number in mind as we're thinking about what our own individual retirement goal could be. So with that, we spent a little bit of time talking about what you need in retirement, right? And the questions that you should be asking yourselves around your goals, around ultimately trying to create a retirement budget for yourself. Now let's talk about how you feed that budget, right? So what are the different income sources that an individual or a couple could have in retirement? And for this one, I was hoping we could, Isma, you did such a nice job talking about the goal and the things that need to be considered in creating that budget. I was hoping maybe you could talk about what feeds that budget, right? The different income sources as well.
Right. So let's say that we mentioned Social Security a little bit. So as you're planning the budget, let's say you're planning to retire at 67, for example. If you've met with the Social Security Administration, or if you've gone online and seen your numbers, and you can see that the husband could make, if he was a primary breadwinner, he may be making $2,000, and the non-working spouse could be making, say $1,100 or $1,000. So that's $36,000 before taxes from Social Security. Then if you're living on $48,000 and that's your budget, then you have to figure out how are we going to take the rest of the income. Is it going to come from your IRA accounts? Do you have some bank accounts, CDs, savings accounts, checking accounts? Perhaps you have a rental home, maybe a side business. So then you're coming up with that whole budget of, let's say if you have a $100,000 CD, maybe you have a $100,000 annuity, maybe they offer guaranteed income from that annuity. If it's a bank account and you are very conservative, with the current rate environment, it's not going to be that much. So do you want to take, some of that and park it into a different investment bucket? So if you plan earlier, the earlier you start, the better you can project that out. And then of course you have 401ks, IRAs, and the health savings account that we're going to discuss a little bit in future slides. But yeah, looking at all of them and then creating a budget. One thing I will mention on that slide real quick, is that don't go to your 401k and withdraw money first, because that's growing tax deferred. So let your IRAs and 401ks grow. And if you have a Roth IRA as well as an IRA, your Roth bucket should always be touched at the end, very last bucket. Why? Because that money will come out tax-free and it's growing tax-free. So the longer, and people sometimes think opposite, they think, well, I want to touch that first because it's not costing me any money to take it out. But that's not true. You want it to grow the most because you want to touch it at the very end. The other thing I'll mention real quick on Roth IRAs is that should be not the bucket that you're leaving to charity, because it could go to your beneficiaries and it could be for your usage, completely tax-free. So just a side note there, but yeah.
So we're gonna dive into each one of these six. We've got a slide prepared on each one of these six topics. Let's just take a moment and just hit the highlights on Social Security here. Particularly, I think you mentioned earlier, Isma, that there is a SSA.gov that you'd ask everyone to go ahead and create an account on. I think you mentioned that in an earlier slide. So just wanted to show that we've got that link here available for folks. Again, that's SSA.gov. Anything else that you wanted to mention on Social Security before we talk about employment and retirement?
Yes. So Social Security, as it mentions here, 10 years, as long as someone has put in their 40 full quarters, but their spouse doesn't have to. If the spouse only worked 20 quarters, and let's say her benefit, and I keep saying her, and I don't mean to be gender biased by any means, but if the non-working spouse or the spouse that had the least amount of income would, let's say, qualify on their own merit for $500 a month. But if the working spouse that has put in the full 10 years or 40 quarters, they qualify for, say, $2,500. The spouse with the lower Social Security income has the option to pick, obviously, their lower amount or half of their working spouses. So obviously the choice is obvious here. And the other thing I want to mention real quick is if the person collects at 62, they have the option to do that at a reduced benefit. It's called reduced benefit, or they can wait till 65 or 67, depending on their date of birth. They can collect a full retirement benefit at 65, 66, or 67. And as a bonus, if they don't collect at 65, 66, or 67, and they wait until they're 70, each year that they wait after their full retirement age, they get an 8% increase. So say someone qualifies at 66 and they don't collect it till 70, they have a 32% increase. So the $2,000 example that I used before, if the spouse doesn't take $2,000, now he can collect $3,000 at the age of 70, and say, God forbid, he passes away at 75. Now his wife will collect for the rest of her life that higher benefit. So I wanted to mention that real quick. And of course, if you do have some sort of an illness, God forbid, or there's not a longevity in your family, and you may want to collect at 62. So there's not a one size fit all answer here, but just based on your own situation and your own needs, you may want to make that decision as such. So that's what I wanted to mention here. Yeah.
Awesome.
As far as working in retirement, Allocation, that you mentioned, one key takeaway here is that if you're working for 2021, the amount is $18,960. So let's say, someone at the age of 65 decides, well, I want to retire. I have enough money put away. They retire 5 months later, they're bored. They go and get a job. They're very smart. They have a intellectual capital that they're utilizing, consulting or something, and they're making $30,000, but also collecting Social Security, but they're not a full retirement age yet, meaning they're not yet 65, so they're collecting at age 62 or 63 or 64. If they're making more than $18,000, $18,960, for every $2 that they make, $1 will go to penalty. Meaning Social Security, if their Social Security benefit was $2,000, they will only pay the recipient $1,000. So it doesn't make sense to lose $20,000 and make $19,000 or $20,000 and then pay tax on that money. So just be cognizant of that, and then discuss it with your CPA or the Social Security representative before you start collecting. So I would just mention that real quick. What you could do is, if you are working, just make sure that your income is below that threshold. In 2013, that number was 15,000. So each year they give you a raise about a few percentage points. So possibly by the time most of you are in retirement, it may be a higher number. So just FYI there.
Excellent. You mentioned bank accounts earlier. I don't know if there's anything specific you wanted to add here.
Yeah, what I would like to add is that, even in a very conservative environment like right now, bank money markets are paying equal to 0%. I think somebody brought me a BMO Harris a statement, and somebody else brought me a Chase statement. It was 0.004 on $150,000. I mean, it's like pennies, right? Or a few dollars. So that's not the best way. If you're 10 years from retirement, this is not where you should be. There are plenty of options available that are secure, that are safe, that are at no fee, that are fixed and guaranteed, that are available to you, and possibly even on a tax deferred basis. So, I know that, when we see a bank and it's FDIC insured, it's a feel good feeling, but there are plenty of other opportunities available as well that you can go into, especially in this low rate environment. And these low rates environment, it's a cyclical thing. They will change. These things will change. This time will change. And soon we will have our 2 to 3% or whatever in the money market account. So don't settle for less. Shop around, talk to an advisor, reach out to one of us, and I'm sure we could direct you into something that's doing better than 0.004 or something. But for liquidity, I would say for bank account, for your 3 to 6 months worth of expenses, especially if you're close to retirement, or if you're in retirement, you want to keep about 1 year's worth of expenses in a very liquid savings money market, fully liquid, meaning fully accessible account. So then you don't have anything locked in if something comes up, unexpected.
Awesome. And I know we're gonna have a question later on kind of a deep dive on 401ks and how to take advantage of them. But I thought it might be worthwhile to just take a moment to kind of cover the highlights of the 401k for us, just so the audience kind of knows, kind of going into the second half of the webinar, that we're going to go into a lot more detail.
Sure. So the best thing I like about the 401k is that most employers, almost every one of my clients that has a 401k, their employer offers a match. So where would you be able to go and get, whether they're matching 25 cents on the dollar, 50 cents on the dollar, and most employers offer dollar for dollar match up to 3% or up to 6%, doesn't matter. Even if it's just 3% of your income, and if you're making $50,000 and you're contributing $1,500, that's 3% of your income, they will give you $1,500. That's 100% match. There is no investment out there that on day one will give you 100% match. And then that money grows tax deferred, meaning you're not paying tax on that $1,500 that you contributed. You're not paying your tax on the $1,500 that your employer gave you. So now you have $3,000 completely tax deferred. I'm not going to say tax free yet. It's tax deferred, and it goes into a bucket, out of sight, out of mind. It was like a bill that got paid, and it's in there. One other thing I'll mention real quick is if you are wise enough and if you're going to contribute to your traditional 401k, most employers these days now offer a Roth 401k option. So real quick, I'll mention this, that 401k pre-tax dollars are obviously not taxed because they're pre-taxed. They're not taxed right now, but they have a tax deferred growth. And I say tax deferred because the taxes are deferred. And then when you withdraw it in your retirement, hopefully you're in a lower tax bracket, and then you can withdraw the funds at a lower tax bracket. If you're doing 50% in your traditional 401k, that's tax deferred, and 50% in your Roth 401k, that money that goes into your Roth 401k, you are not getting a tax break on that, and you are not getting a tax immediate tax break, but it's not growing tax deferred. It's growing tax free forever. And God forbid if you pass away and it goes to any of your beneficiaries, your spouse, your children, your relatives, it will go to them completely tax free. And there are very few things in this country that are completely tax free. So Roth is one of my favorite investments Very few of us qualify for that because there are income limitations, which you guys can Google, I'm sure. One of the main things here highlighted is that make sure that your beneficiary information on any of your IRAs, Roth IRAs, any of your CDs, any of your bank accounts, 401ks are completely updated. And I'll add one more point, not just your primary beneficiary, but also your contingent beneficiary. So let's say, for example, a couple, a husband and wife, a husband has his wife, wife has her husband, God forbid they were driving together, and God forbid they both pass away together or simultaneously, then where does the money go? Then it will be frozen and it'll go through probate. But IRAs, 401ks, and life insurance policies can be completely probate free because they have designated beneficiaries. So please make sure that you're having not just primary beneficiaries listed, but you can also have contingent beneficiary listed. Also, real quick, primary beneficiary doesn't have to be just one person. You could have 5 primary beneficiaries or as many as you like. Also, the same is true for contingent beneficiaries. You could also have charities as your beneficiaries, primary or contingent. And when the charity gets your pre-tax dollars, that charity does not have to pay any tax on your 401k. So just speaking of beneficiaries, I just wanted to add a couple of extra points there.
Excellent. Thanks, Ismat. So just, a couple other income streams left in retirement for us to cover, and then I think we'll kind of dive into this in a little more detail. So IRAs are the next source.
Right. IRAs are the next source. And IRAs, if you have a choice, let's say if you said, well, I have $15,000, should I go into my 401k or should I go into an IRA? And assuming that you qualify to do both, right? And most of us, there is no income limitation for 401k. So if your employer offers it, then you can qualify. As far as IRAs or Roth IRAs are concerned, there is income limitations, which you can work with your CPA or your tax advisor, and they could assist you with whether you qualify or not. So if you, let's say somebody comes to me and says, well, I have $15,000 total, that's all I can afford to put away. I'm allowed to put away that much in my 401k. What should I do? And let's say that employer matches the first $5,000 of their contribution. Then I would say put that $5,000 or even $10,000 into the 401k because you're getting the match. And then take the difference, and if you qualify, put it into an IRA. And if you qualify, put it into a Roth IRA. Now, some people will say, well, why do I put it into a Roth IRA? I'm not getting a tax break. So if I can put away $7,000 in an IRA or $7,000 in a Roth IRA, why don't I just do an IRA? Because I get the tax deduction and I don't have to pay tax on it. But remember, when that 7,000 becomes 14,000, and then when 14,000 becomes 28,000, all of this is going to be taxable in your retirement. So the younger you are, the more beneficial it is for you to do a Roth IRA contribution. But if you qualify for all of them, you can't qualify for IRA and Roth IRA. You could split it. So if you qualify for $6,000, you could put 3 in your IRA and 3 in your Roth IRA. Roth IRAs have a little bit of a higher income limit. So there's many ways to slice this, but each situation is unique. So, sit down with your financial advisor or call one of us, and we will be happy to assist you as far as that. Now, in a traditional and a Roth IRA, because you're working with an individual advisor or your own institution, there are thousands of choices. When you are working within a 401k menu, you are at the mercy of your employer's menu, which could be, they've been very generous. When we do 401ks for companies, I think we're offering at least 20, it used to be about 7 or 8, but now there are about 15 to 20. There are quite a few options available. And then you can, buy and get in and get out of it at no cost. So that's another benefit of, going within a 401k. But traditional IRA obviously have lower contribution limits. There is a next slide that we will cover that more in detail. And then let's say if a husband is working or if one of the spouses is working and one spouse is non-working spouse, and there is one income, and let's say it's $70,000. And let's say they're both under the age of 50. The working spouse can contribute to his 401k and also an IRA or a Roth IRA. And because he's working and they're filing joint taxes, this non-working spouse can also contribute based on their age. So assuming they're under the age of 50, they can contribute another $6,000 for the non-working spouse as well. You cannot do that for children. So let's say if you have 2 kids and a non-working spouse, you couldn't start an IRA. Only a spouse can have a non-earned income from an earning spouse, W-2 income that is. It couldn't be from an investment in that. So that's a really huge benefit that I think most people don't take advantage of it. So something to consider.
Awesome. It's too bad it's not available for kids. I feel like that would completely redefine generational wealth planning.
Yeah, absolutely. You know, since you mentioned it, I'll real quick mention this, and I've given this to a lot of my Smiley clients. I've mentioned this and they do this. If you own a business and if the kids are, we used to own a business and I was using my children's picture for marketing purposes, and there's no limit to what I could pay them. So I used to pay them $2,000 or $3,000 when they were very young. Then I had to pay a 1099 income for them. They had to file their tax return because they got income. And then we started a Roth IRA a very long time ago for them. So you could do that if you have the luxury of have a business, or you could pay your children. And even if you don't own a business and you're a W-2 employee, like most of us are, you could then pay your children for, mowing the lawn or doing housework or helping you with some other things. As long as you are paying them and you pay tax on the income that you pay them, absolutely, you could start a traditional or a Roth IRA for them. You could have a 401k because you have to be an employer to do that. But, if you're a business owner, you could definitely do a simple plan or a set plan. So yeah, that is a good point, Alikan. You could do that. A little bit more involved there, no pain, no gain. There's a little bit of involved, but it's definitely beneficial, especially if you do it for 20 to 30 years. It really adds up.
So the last income source that we wanted to make sure we hit on quickly, and then we'll move on to kind of the larger kind of story that we want to tell tonight, is HSAs, which I know are top of mind for a lot of folks, given the pandemic and everything that's been going on over the last year. If there are any kind of key points here, Isma, that you wanted to highlight, and then we'll move on.
Yeah, so healthcare expenses in retirement can be unpredictable and costly. A health savings account, or we call it HSA, can help save for medical expenses now and in the future. You could use the money that you save now in the future, 10 years out, 20 years out, but you need to be enrolled in a high deductible healthcare plan to contribute to an HSA. An HSA allows tax-free withdrawals for doctor visits, prescriptions, medical, dental. It may also cover some other healthcare expenses that are typically not covered by insurance or Medicare. This is all listed in the IRS publication 502. If you would please write it down, like Ali Khan said, make sure you have a pen and a paper handy. Please jot this down, www.irs.gov, publication 502. It will give you the details on HSA. It is important to note that an HSA offers a triple tax benefit. So your contributions go into your account pre-taxed. So remember, in your 401k, your contributions were going tax pre-tax, and then they were growing in a tax deferred basis and then coming out taxable. Not in an HSA. An HSA goes in pre-tax, it grows tax-free, and it comes out for eligible expenses completely tax-free. So, sometimes people confuse HSA with FSA. They say, well, if I don't use it, I lose it. That's not the case. HSA, if you don't use it, you don't lose it. It rolls over as an IRA, just stays in the account, and it just builds the bucket. So let's say you're allowed to put away X number of dollars, and 5 years down the road, you have $30,000 in that account. And God forbid, there's a huge medical expense that came up. You can then dip into all of that $30,000, take it out completely tax-free. Again, for qualified expenses only. So yeah, that's what I wanted to mention about the HSA.
Yeah, and I'm glad you brought up the difference between FSA and HSA. That's perfect. So now that we've covered, what does retirement look like for me? What are the different ways, and then, creating that budget. Now, what are the different income streams that are going to feed that budget? I think we covered that in a lot of depth, and we're going to spend a little more time on some of those vehicles in the second half here. I was thinking, we've got a variety of folks on the call, obviously tonight, We have folks who are very earlier in their career who are asking questions about, I just started my first job out of college, trying to figure out how to prepare for retirement. We also have folks who are much further in their careers who are also trying to figure out, how best to prepare for retirement. And so I think the general question here is, how do you get on track? And so, Isma, just kind of, finishing the story that you've helped start here, if you could help us answer that question.
Sure. So I'll start, with the first thing that I said was like, let's just figure it out. If you're 40 and you want to retire at 65, one thing I will say real quick is, let's say I've recently, especially with COVID, people are kind of, if they can't go outside, they're going inside, right? So they're self-reflecting and they're saying, I've been working really hard. I want to retire at 55. And the first thing I bring up is, if you retire at 55 and Medicare does not cover you until age 65, do you have enough assets saved up to have private insurance that covers you, your spouse, and your children? And 90% of the time, the answer is no, I don't have another source of, income that will pay for my insurance. And so then they have a change of heart. They're like, yeah, I don't know what I was thinking. Maybe I'll retire at 62. So have a set age in mind as far as if you're 40, you want to retire at 65, that's 25 years. Have some sort of a estimate. And then if you're living on, let's say, X number of dollars, whether it's 50,000, 100,000, whatever that is, extract out of that how much is going to the mortgage. Because when you're retired, hopefully you don't have a mortgage. So if I can give you one advice too, that would be, don't retire pre-65 unless you have a good source of money set aside to cover you for insurance. And also, please don't consider retirement unless you have your mortgage paid off. Don't have a big expense on the side, because you want to be able to enjoy your retirement and not, live with dignity in your retirement. So start with the plan in place, as far as what year you want to retire. And it won't never be exact. It would be a couple years before, maybe a few years after. And then also start with the budget in mind. So it, again, won't be exactly the same, because things may cost X now, they may cost less, or they may cost more. So, but have, plus or minus 10 or 20%. So have some, just like when you're planning a vacation, planning anything, you start somewhere. So have those goals as precise as you possibly can have. And then, start tightening that up as you go. Going back to this slide, and one thing I want to mention about HSA that I like is with the traditional and Roth IRA, there are income limits. With the 401k, the good news is there is no limit. And with HSA, there is no limit. So for those of you on the call who have a high income tax bracket, 401k, if you're working for someone, is a great way to put away money pre-tax. But even if you're not working for an employer, just that you have a high deductible plan. With a lot of my Smiley business owner clients have the high deductible insurance plan, and they qualify. So you could go to most banks, most financial institutions, they offer HSA. And even if your spouse is working and you're working, both of you can have separate HSAs. So that's quite a bit of money that you could put away and not have to pay tax on it. And you can use that money not only for yourself, your spouse, but also for your children for qualified expenses, like we said.
Awesome. So I know we wanted to take a little bit more time to start talking about, other ways that you can get on track. I think earlier I think some of you mentioned earlier, there was the concept of like a rollover, right? And we actually have also had a couple questions pop up in the chat here about rollovers as well. So wanted to just take a moment and just kind of start talking about that as potential options. And then we've got a slide right after this that goes in a little detail on rollovers as well.
Sure. So let's say that someone left IBM and they've been there 20 years. They could have a easily, $1 million 401k, and they now go and work for a competitor, or they retired, whatever the situation may be. The bottom line is they're no longer with their current employer, but they have a, very large 401k, and they're concerned that, they have 10 or 12 choices, or maybe top 15 choices, and they have a lot of money within the small menu of choices. So they can choose to roll over all of it or part of it. They could do it from institution to institution. So let's say that the 401k was with XYZ company, and now they want to go to Merrill Lynch or Fidelity or Schwab. They can take it, all of it, and move it all over to the new institution, or they could take portion of it and move it into the new IRA account. Or if they're leaving and working for a competitor, they can take, again, they can take all of it or some of it to the new employer. The reason I don't recommend taking your existing 401k to the new employer, let's say that you have been with the company 20 years, you could easily work for the new company another 20 years. You don't, and you're contributing to the new company. You don't want to have all of your eggs in one basket. So you want to have diversification of asset. So you have an option of, leaving it to your existing company, taking it to the new company, or rolling it over into your own, institution that you do your financial planning with. And then they can help you diversify it out. And most financial institutions will have, God, I know, 1,500 to several thousand choices. And you want to have the diversification. You don't want to have it into a small menu of choices. So that's one thing I want to mention. The other thing you could do is, let's say that you have $1 million 401k, you are converting, say, $300,000 into an IRA, and then from an IRA, you can convert it into a Roth IRA. I'll mention real quick, a lot of my younger clients, I've encouraged them to do that. And, sometimes their CPA will say, well, why are we paying taxes on that money right now? Well, IRAs and 401ks will be taxed someday anyways. And, as my clients' assets and net worth is growing, they may be in a higher tax bracket. And as you know, in our country right now, with all the stimulus money going out, somebody's going to have to make up that difference, and it's going to be via taxes. So our tax brackets are never going to go down. They're only going to go up, especially for increasing our net worth. So it's better to convert now and pay the tax on the IRA, conversion to a Roth IRA, and then let the Roth IRA grow tax-free forever and ever, to your spouse, to your children, to your other beneficiaries. I will say one thing is that if you have $300,000, let's say, and whether it's $300,000 or $30,000, doesn't matter. You don't have to convert all of it in 1 year. You can have a 5-year plan, you can have a 6-year plan, you can have a 10-year plan, and take a chunk out from your 401k as you're converting. But from a 401k, the assets must go into an IRA first, and then they can get converted to a Roth IRA over the years. Usually for my clients, I usually go over between 3 to 7 years, mostly about 5 years is my average, and then we just convert it out. The younger the client, the more I opt to do this. The older the client, the more I shy away from that, because there's not enough time for them to, let it grow tax-free. So hopefully that makes sense.
Awesome. So I think I'll just leave this slide up for a moment here, but I think we actually covered most of this in the previous slide. What I was hoping we could kind of jump to is just some other tips that you could share with us, Isma, on other things to think about as people are trying to get on track to retirement, right? So we spent a lot of time on rollovers, both 401k and IRA. But there's some other things that people can do too. And some of these are quick wins. So I was hoping you might be able to share some insight on these too.
Sure. So on the last slide, if you could go back one more, there was one topic that we didn't cover, and it was called indirect rollover. And indirect rollover, really quick, is something that I don't recommend, but sometimes it happens. It's not a bad thing. A direct rollover or direct transfer is from an institution to an institution. And indirect rollover or indirect transfer is where, let's say if I work for IBM, they call and say, the HR, I quit. I no longer want to keep my 401k there. And they didn't talk to their new institution. The person talking to them on the other line had them sign a form, and they sent the individual the check for their $300,000 withdrawal or whatever. That's called indirect, meaning it's not going from institution to institution. It's going from an institution to the person, and then from the person back to the institution. The IRS can, be red flagged if one of the 1099s didn't get reported to the IRS. It can get messy. If you want it to be invested, have your new institution deal with your last institution. That way it's clean. then that institution will, the receiving institution will report the receiving information, and the sending institution will report it, and you stay out of it. So I think that's a little bit cleaner. So I just want to mention that really quick. And we did mention the greater flexibility. One thing mentioned here again is there is one rollover per 12-month period per plan. So if you have 3 401ks, you can definitely roll all of them out, but per institution is one. So if you work for 3 companies, you can roll all of them out in the same year. That's allowed. As far as I keep going back to saying the same thing, like start somewhere, right? And even if you say, well, there's no way I can start with, several $1,000s. I don't care if you start with $50 a month, if it's $25 a month, whatever the number is. I always give my younger clients or my children of my clients an example of, there was a time when gas fuel used to cost $4 a gallon or $4.50 a gallon. Not too long ago in California, gas was like almost $6 a gallon, right? So when gas prices go up, or when electricity or cell phones or whatever goes up, we pay that bill and we don't look back. So, kind of pay yourself first and don't think about it. Even if it's $25 a week, $50 a month, $100 a month, whatever it is, just do that, especially if there is a match available from your 401k. So if you're for long-term planning, and one thing that's mentioned here that's really good point here, it's listed at the bottom, pay off debt. So what good is getting your employer's 3% match if you have a credit card debt that's costing you 17%, right? So pay off your debt. Hopefully, most people in the audience here don't have a lot of credit card debt. That's my least favorite debt. I just don't like to see that. Of course, have credit cards. Take the benefits, take your points, whatever they are offering, take that. But don't pay them the interest. It is just not wise to have credit card interest. If you have a 0% credit card for a short term, that's fine, but don't go into the habit of going from 0% to 0%, affects your credit and such. So always try to stay out of credit card debt because it's not smart debt. If you, especially for homeowners, if you can get a home equity line of credit, which is at 3% or even 2 or 4% in such a low environment, have that out there. And some people will say, well, I don't like to borrow on my house. Well, if you have a debt in your name, have it on your house or have it on a credit card debt. So smart debt is tax efficient debt, meaning if you have a home equity line of credit debt or a mortgage debt, that interest rate that you pay towards it is tax deductible. A credit card debt or a car loan debt is not tax deductible. So please be wise. All of this, what we're talking about, we've mentioned that in our previous seminars. Anything that we're talking about here savings wise, none of it is any good unless you have your especially credit card debt or car loan debt paid off, especially if it's at a high interest rate. So I want to mention that here. The second thing would be to have a savings plan. So don't park all of your every last dollar in your 401k or your IRA. Have an emergency fund, whatever that fund may be. Whatever your expenses are, of course, it will be based on that. If you have children, that emergency fund needs to be higher. If the two spouses are both working, then that budget needs to be even a little bit higher, right? So just be very aware of, let's, stop the bleeding, turn off the faucet where it's bleeding from, and then you can only go in the right direction, because you can't have it going in the right direction here, +1, but -3 on the other side of the balance sheet. That would not work in the long run.
And I'll just mention that we, on the national EPB team, we're also very fortunate that we have debt management and debt consolidation resources available for the Jamaat. If anyone is interested in that, there will be an email address that we're going to share at the end of the webinar today, where you can reach out and ask for those types of services, and they'll go into even more detail than Isma just did with you on an individual basis. So with that, I wanted to kind of just lay out one more quiz here. So Isma gave us a really nice example of, if you haven't started, saving for your retirement, there's no better time than the present. And I think this quiz question will help highlight just the power that's available to you, even if your retirement account right now says 0. So in this question, if you invested $1,000 per year at age 27, just give me a minute, I'm trying to remember what that was like a long time ago, and averaged an annualized return of $10 per year, how much would you have 40 years later at age 67? So just, again, you started at age 27, you're putting away a little under $100 a month towards your retirement, an annualized return of 10% per year. How much do you think you'd have in 40 years? And there won't be a poll on this one, but as you're kind of thinking about it, I think the natural answer that you would think is 40,000, but that 10% annualized return per year actually makes a huge difference, and you can see it illustrated in the graph below. And the answer is actually $500,000, $500,000. So the key here is that even, small bite-sized amounts of contributions towards your retirement planning can have a huge impact over time. And with that, speaking of small kind of bite-sized contributions to your retirement, I wanted to kind of change gears a little bit and talk about a tool that is available to a lot of the professionals in the Jamaat called a 401k. With that, I think, Aliyah, if you can tell us a little bit about, your thoughts on 401k as in relates to this particular tool. It's such a powerful tool. I think we've all heard about it in our different benefits plans on the first day of work, and then, a lot of times you never hear about it again. So maybe you can help illustrate for us how you can achieve your retirement goals through a 401k.
Sure. I do think, though, that Ismat was covering this one, so I'll just let her finish this one, and then I'll take the next one.
Sure.
Oh, no problem.
Sure. Ismat, yeah, go for it.
I was going to say, one of the things I like about the 401k is that, like I mentioned, it's out of sight, out of mind. You, on your day one, your HR person asks you, how much you want to contribute. And let's say maybe when you started the work, you were new, you didn't have the resources to contribute. Every year they give you the ability to, select how much you want to add to your 401k. And if you just have it deduct automatically from your paycheck, it just gets done. And like we mentioned in the earlier slides, you could have a traditional pre-tax or a Roth 401k option. Your employer match, however, will only go to the pre-tax because they want to take their deduction. So their match will always go into the pre-tax bucket. Only your contributions will go into the Roth 401k. The maximum this year for individuals under the age of 59 and a half, under the age of 50 is $19,500. That doesn't mean that you have to contribute $19,500. Maybe you can only contribute, $5,000 or $6,500 per paycheck. But remember, when you're contributing the max, let's say around $20,000, and you're in a 15% tax bracket, you just saved $3,000. So you really didn't contribute $19,500. You contributed only $16,500, right? Because if you had brought this money home, you would have paid about $3,000 in taxes. And most of us are not in 15% tax bracket. We're in about 18 to, maybe even 30% tax bracket. So the higher your tax bracket, the more it makes sense. And especially if you're over the age of 50, you can contribute as much as $26,000. And again, like I said, out of sight, out of mind, just have it deducted, it's gone. You could borrow from your 401k. People will say, well, I can't touch it. I'm only 30 years old. I can't touch it until I'm 59 and a half. I don't want to do it. You could borrow from it. But again, this presentation we're doing today is not to teach you about withdrawing from your 401k. It really is to encourage the Jamaat to add to their 401k and add to their future savings. And of course, the employer match that I mentioned earlier, that's a freebie. I mean, whether it's 25 cents on the dollar or a dollar for dollar, even if there is no match, it still makes sense from the tax savings itself to go ahead and do that.
Excellent. Thank you for that, Ismat. So just to kind of recap, what we're covering. I think we spent a little bit of time talking about the retirement goal itself, really trying to understand, how that individual goal matters to each of you as you're thinking about what your retirement life could be like, what you want to accomplish in your retirement, and then thinking about the different income streams, using that to create your budget, getting an opportunity to practice that budget before while you're still working, right? Before your retirement actually begins, right? Think of it as a practice round. So we heard Isma talk a little bit about that. And now, even trying to dive into the different tools, right? So we covered the different income streams and then spent a little more time on 401k. Next, I wanted to just take a moment for Aaliyah to tell us a little bit about the different things that we should consider when we're looking at those investment tools. So whether it's a 401k, an IRA, et cetera. And I know that, you wanted to, just like we've seen in previous webinars, Leah, the kind of three factors, right? And then I think we'll kind of dive into those from there.
Absolutely. Thank you, Ali Khan, and thank you, Ismet. So just as Ismet has been discussing about saving into the different account vehicles, now we basically need to understand how to invest that so that it can grow. So when you think about investing for retirement, there are three main factors to consider. The first is your level of diversification across asset classes. So the three primary asset classes we'll be discussing are stocks, also known as equities, bonds, or by another name, fixed income, and cash equivalents, or what's also referred to as short-term investments. So when we say diversification across asset classes, what we mean is, are your portfolio assets allocated in a way that you have exposure to all of these in an appropriate proportion for your situation? The second main factor to consider is your risk tolerance. And risk tolerance is made up of both your willingness to take risk and your ability to take risk. And we'll cover that more in depth shortly. And the third one we have here is your goal time horizon. So the general rule of thumb is to invest more aggressively the farther away your goal start date is. So now if we want to move into risk tolerance, I can deep dive there. So the main takeaway for risk tolerance is the farther away your retirement start date, the more risk you're able to endure. So for example, if your retirement money is in a 401k or an IRA and you're in your 20s and 30s, it hopefully won't be touched for decades. So a more aggressive asset mix makes much more sense because you're able to weather the storm of any volatility that comes along with the potential of higher returns from your more aggressive asset mix, since you have time on your side if you're young. But conversely, if you only have a couple years left until you retire, investing aggressively wouldn't necessarily be wise, because if the stock market turned downward right as you retired, God forbid, you're in a pinch since there's no time left to recover if you need to start withdrawing those assets to live. So in the upcoming slides, let's take a look at some sample asset mixes. And again, these are for illustration only.
Yeah, I think that just keeping an eye on some of the questions, there's, as we're going through these next sets of slides, Aaliyah, help paint the story for us, because we've got folks again who, for example, there's a sample question around, I'm just starting my career. How should I be thinking about investing, to somebody who's saying, they're 60 years old, and how should they be thinking about investing towards their retirement, right, as well. So just as we go through these next couple of slides, those folks who ask those particular questions, or if that question also describes you in the audience, pay particular attention to these next few slides as we go through that.
Thank you so much for calling that out. Yeah, that's really helpful. So in this first slide, where you're about 13 or more years away from retirement. So this would, of course, apply to that first cohort of folks you mentioned, if you're in your 20s, 30s, 40s even, this slide is for you. So again, these next few charts are just samples for illustration. And so in this case, you're 13 or more years away from retirement. So an aggressive growth portfolio may be appropriate since you have a lot of time to weather any storms from the riskier asset classes of stocks that this asset mix has a high allocation to. Which is the trade-off you make for higher expected returns. And so what makes this an aggressive growth portfolio is its high allocation to equities or stocks synonymously. So in this case, if we add the orange and the red dots, which you can see in the legend are the domestic and foreign stocks, if we add those together, this aggressive growth portfolio is at 85% equity. And notice that it doesn't even have an allocation to cash equivalents or short-term investments. You might see both terms in different places because the low return from those cash equivalents would actually drag the portfolio return down, which isn't necessary when you have over a decade left to even begin your goal. But now, if we move to the next slide, let's say you're getting a tad closer to retirement. You're, let's say, between 9 to 12 years away. If we just look at the orange, now the target, the orange and the red, now the target domestic and foreign equity has decreased from what we saw in the previous slide, which was 85% to 70% if you add those two together. And that represents following the path of getting more conservative the closer you get to retirement. And we can see this pattern again if we go to the next slide. So now let's say you're even closer to retirement. You're about 1 to 8 years away. So now that total target equity has decreased from what we saw in the first slide of 85% to the second chart, which is 70%, and now it's at 60%. And you notice that the allocation to bonds and cash has, of course, increased because the allocation to equities has decreased. And the purpose of that is that you have more of a buffer in your portfolio the closer you get to retirement for that added safety, since you don't have time on your side from the more volatile, riskier asset classes. And then we have one last one. So now let's say you finally reached retirement or even in retirement, which is what they mean by the -5, the equity percent is decreased yet again. But what I'll point out is that it hasn't gone to zero. And the reason is because you'll still be in retirement for 20 to 30 years, hopefully. And if you were to go to cash completely, you'd exhaust your assets in retirement much more quickly because you'd be withdrawing from something that isn't growing. So this way, if you still maintain some prudent, a conservative amount of exposure to stocks, you'll be able to sustain withdrawals from those accounts for a longer period of time if you're exposed to market growth in at least a balanced way. And one of the pitfalls we've been seeing far too often, unfortunately, is people taking too much risk close to retirement because they're anxious that they don't have adequate retirement funds. But if you think back to the global financial crisis in 2008, if you had become aggressive right then and also needed to retire during that same time frame, you may have lost a majority of your account's assets, which may have been nearly impossible to recover from. So there are definite consequences to immediate gratification of seeking risk in anticipation of higher returns. So it's best not to make these emotional, fear-based investment decisions and invest prudently according to these target asset mixes and these glide paths that we've been looking at.
Excellent. This is super helpful, Leah. And I think for some of the folks who'd had kind of questions around this, again, kind of ranging from, this is my first job to I'm now 60. And I think there was one in there that was in between those two phases as well. So hopefully we were able to address some of those questions in the audience right off the bat. I think you also had a little bit to share on the different types of funds, right? And we've got a couple of slides on this quickly as well.
Definitely. So one thing I definitely acknowledge is that it's difficult to monitor and maintain and manage your own glide path meaning that that roll down from aggressive to conservative, as we were seeing in the previous slide. So you might want a solution where a portfolio manager does that for you instead of you having to do that all yourself, because it does get complicated with multiple asset classes and then having to change the allocation and wondering what to sell and what to buy. So this is the solution for that. So a target date fund is a fund that dynamically reduces your risk as you approach your retirement date. And this is what the mutual fund portfolio manager automatically does for you. So you basically just make an investment in that fund, and that roll down or that glide path going from aggressive to conservative is done for you, and you don't really have to do anything. So target date funds are usually named by the year in which the investor plans to begin utilizing the assets. For example, if you wanted to retire in 2060, you'd look for a target date fund with 2060 in the title. And a target date fund's risk tolerance becomes more conservative as it approaches its objective target date. And I just mentioned the thing about the target, the vintage year, like in that case, I used 2060. I mentioned that because these might be part of your 401k plan lineup. And I just wanted you to be familiar with what those meant. And then the other type of funds are target allocation funds. They're also sometimes called target risk funds, but I'll continue to call them target allocation funds. So these provide the opportunity to get a well-diversified asset allocation in a single mutual fund, but the difference is these funds build a mix of stocks and bonds that align to one constant targeted risk level. It's not tied to a time horizon like target date funds. So there's going to be no roll down, no glide path. It's going to be like a bullet of one targeted constant risk level. So if you used a target allocation fund within your portfolio, you'd most likely need to work with your financial advisor to figure out how to reduce the risk in other areas of your portfolio as you approach retirement, because this particular fund flavor will stay at a constant level of risk. So let me deep dive a little bit more into the target date funds, because this one's especially important, especially because the portfolio manager is doing the roll down for you. This is basically just another way of looking at what we were looking at in all of those pie charts a few minutes ago. But this is like all of the pie charts all in one place. So let's say, for example, you're 32 years old. And because you have decades to go before retirement, you have the highest stock allocation on the graph. And then as you approach your retirement date of, let's say, 67, the allocation to stocks reduces, which de-risks your portfolio such that your portfolio is more secure closer to when you need the money. So even if you're a lot older than 32 and haven't started yet, no worries. Just instead of allocating 90% to equities as it shows on this chart, maybe 50% of equities as the chart shows is more prudent. So you can maybe consult some of those. I know they're just sample and for illustration, but just to get a rough idea of what your target mix is depending on how far you are from retirement, those pie charts would be helpful. But this was just another view to kind of solidify the concept.
Awesome. So another way to kind of think about this, just to make sure I understand too, is, you know, what we're seeing here is a target allocation fund or target date allocation fund. But if we were to do just a target risk allocation fund, you'd just see basically 3 flat bars all the way across.
Exactly.
Is that right?
Yes. Thank you so much for saying
cool.
that.
Cool. Awesome.
Wonderful. So wanted. Oh, sorry. Go ahead. Go ahead.
Oh, I was just going to say, I wanted to make sure we covered the elephant in the room with beneficiaries as well.
Definitely. Yeah. So one thing we want to emphasize, which is very low effort, but very high impact, is the importance of setting and reviewing your beneficiaries for all accounts. If you haven't made these designations yet, please do it tonight after the webinar. And if you haven't reviewed it in the last year yet, or within the year, if a major life event occurred, like having a child or getting a divorce, please do that tonight also and continue to monitor it, because beneficiary designations on your retirement accounts also override your will and save you probate hassles later, as Ismet had mentioned.
Fantastic. Yeah, great call out. So we just to kind of help the audience kind of paint the story here, we started with what does retirement look like for me? How do I create this retirement budget? How am I going to fund my retirement through all these different income streams that we spent some time learning about? How do I determine, what are the tools that are available for me to determine if I'm on track or get me on track today? We learned a little bit about compound interest and the power of compounding. And now we learned a lot about, between those IRAs, HSAs, 401ks, what are the different types of investment funds that are available to me? Now let's kind of fast forward a little bit and assume that, okay, somebody's now very close to or is already in retirement. How should they be thinking about their drawdown strategies, right? And I think, for the folks that are still preparing for retirement, this is really important information for you as well, because it might help kind of set your plans and your strategy towards retirement.
Yeah,
so Aaliyah, can you enlighten us a little there?
Absolutely. So one important income source in retirement is, of course, your Social Security income, but there are some nuances we'd like to remind you of. So you can begin claiming Social Security anywhere between 62 to 70 years of age, but the longer you wait, the more you'll receive. Let's look at an example. So let's take Nusrat. If Nusrat is expected to live till 84, she can get varying amounts depending on when she starts claiming. So if she starts claiming at 62, the math is there, and I wrote how you can also calculate it, but just for the sake of time, she can expect about $220,000 in lifetime Social Security income. But if she waits a few years and claims at 66, she can now expect about $240,000 in lifetime Social Security income. And if she waits till the maximum Social Security claiming age of 70, she can expect almost $247,000 in lifetime Social Security income during retirement. So that's about a $27,000 difference for Nusrat between claiming at 62 versus claiming at 70. And of course, if you have severe health issues with a shorter than average life expectancy, or if you have no other accounts to withdraw from and no other way to earn income in retirement, you may need to claim earlier towards that 62 end of the spectrum. But if you don't fall into that camp and you can wait till 70, that will be best for you. And okay, so here's another source of income from in retirement. This is less income and more drawing down from your various accounts, but there's some nuances here because your various retirement funds may have different tax implications. So for example, your taxable accounts are your brokerage accounts. And when you withdraw from these, you'll have to pay capital gains taxes, which includes both federal and state. So make sure that you take both into consideration. If you've held the assets you're selling for over a year, most people normally fall into the 15% long-term federal capital gains bracket. But if you've held it for under a year, the federal capital gains bracket will be your ordinary income tax bracket. And then on top of both of those, you of course add your state tax rate to that as well. If you're withdrawing from a traditional 401k, 403b, rollover IRA, or traditional IRA, you'll be taxed at your ordinary income tax rate. And if you're withdrawing from your Roth IRA or your Roth 401k, you don't owe taxes upon withdrawal because you already contributed after-tax dollars, and that is the nature of those accounts. So speaking with your financial advisor and or your tax advisor is a really good move here to make tax-savvy distribution choices, to figure out which order to do them in, what levels, like what amounts to withdraw from each before you start withdrawing from another. This can get a little complicated and is dependent on your personal financial situation. So this would be a really good point of contact with your advisor.
And not to kind of belabor that point or make it even more complicated, but then there's also the concept of Rmds, right? Or for anybody who subscribes to AARP in the audience, you probably heard this term before, but it stands for required minimum distributions. Leah, maybe you can just enlighten us a little on that rule.
Definitely. So another source of retirement income that you're actually required to take, as it says in the name, are the required minimum distributions. So RMDs apply to almost all retirement account types except for Roth accounts. These distributions need to be made annually by December 31st of every year from age 72 onwards, which is the new RMD start age as of January 2021. And if you don't distribute the correct amount of funds in time, you will incur a 50% penalty on the amounts that weren't withdrawn in time, which is a massive loss. So please make sure you set your calendar reminders and consult your financial and tax advisors to make sure you're withdrawing the right amount across multiple accounts you might have that require RMDs.
Awesome. And I noticed you mentioned that it doesn't apply to Roth, but there are withdrawal rules for Roth as well, right?
Yeah, let's dive into those too. So the last thing I wanted to call out specifically, since it operates a bit differently from the other types of retirement accounts, are the rules related to Roth IRA withdrawals. So there are 4 cohorts you might be in, denoted on this slide. So let's go through them one by one. So if you are over the age of 59 and a half, and you have owned your Roth IRA for more than 5 years, there are 2 pots of money within your Roth IRA that we should consider. So in this case, you're in luck. The earnings are tax-free and penalty-free, and the contributions you've made are tax-free and penalty-free. Actually, before I go on to the other 3, let me just note right up front that the contributions you make to a Roth IRA, no matter which of these 4 cohorts you're in, will always be tax-free and penalty-free, meaning what you put in, not what it grew to and the earnings from those investments, what you put in. Let's say you put in $500, it grew to $700. Your $500 is always tax-free and penalty-free and can be taken out at any time in the Roth IRA product. So having said that, just for efficiency, we can just focus on the first 3 columns because that 4th column of contributions applies to all in the same way. So now let's say that you're over 59 and a half, but you've owned your Roth IRA for under 5 years. So you will have to pay income tax on your earnings, but they will be penalty free. So that's at least good. If you're now under the age of 59 and a half, but you've owned your account for more than 5 years, you'll pay income tax on withdrawing the earnings. Again, we're talking about withdrawing, and you will incur a 10% penalty. For the last cohort, if you're under 59 and a half and you've owned your account for under 5 years, again, you'll pay income tax and have the 10% penalty. So you might be asking, what's the difference between these last 2 rows? So the difference is in that third row, meaning you're under 59 and a half and you've owned your account for more than 5 years, there are a few exceptions that allow you to avoid both taxes and penalties, such as some disability exceptions, or some, if you're a first-time home buyer, they allow you to take 10,000 out without tax and penalty. And they're more than that. Those are just some. And so that's one difference, because in the last row, if you're in that cohort of being under 59 and a half and having owned your account for under 5 years, you can avoid the penalty for those exceptions, like a first-time home buyer that I was talking about, or for things like qualified education expenses, but you'll still owe the income taxes. So this might be a good slide to even take a screenshot of, just for handy dandy reference, because there are some nuances here. And of course, you'd probably have to do a little bit more deep dive research, maybe with your advisor, but these are just some things to keep in mind.
Excellent. And just, and I'll mention this again later, but, the recording for tonight's webinar will also be on the AICC website. So if for whatever reason you're not able to take a screenshot now, you can always access that recording later.
Yes.
Aliyah, just since we've got you, on the webinar tonight, and I know that you mentioned the new rule change with RMDs that just took effect, and as we're looking through some of the questions around, how do I even get started on my retirement? Are there other things that I can take advantage of? Like what else can I do, right? So the good news is there's a lot of energy in the audience around achieving their retirement goals and plans, but I was hoping maybe you could share with us maybe another potential source to jumpstart someone's retirement plan.
Absolutely. Yes. So normally we don't have this other source of potential retirement income, but in this environment we do. So many of you may have received a stimulus check in the past few months, and depending on how legislation continues to evolve, you may again. And we just wanted to remind you, a friendly reminder, since it is February Retirement Savings Month, that it would be a great use of money to put it, if you are eligible to put it in your Roth IRA, that would be a great place to put it. If you're able to put more into your 401k or your traditional IRA, that would be wonderful. But other than the retirement savings, if you also need an emergency fund, let's say you've withdrawn from your emergency fund for some emergencies, which were more than likely in the past a few months or past even year or so, and you need to replenish that account, making sure you pay yourself first, as Ismat was saying, putting it in your emergency fund, paying down debt that you have that's been accumulating silently but dangerously in the background, and of course contributing to your retirement accounts. Those would be wonderful uses of your stimulus money if you're able to do that.
Excellent. Well, we're going to kind of change gears a little bit. No surprise from this audience based on some of the quiz questions and responses, but out of the, I think about 60 plus questions, we've actually addressed a majority of them just through the conversation tonight. We're gonna go ahead and answer a few more here as time permits. But before we do that, I also wanted to just let everyone know that very shortly you're going to be receiving a message around a survey just to provide us feedback. For Aliyah and I and Ismat, like we've been doing this for the better part of a year now on these Money Matters series. As you know, we're very active in responding to your feedback. So wanted to just announce that survey is coming out. If you can take a moment and start responding to that as well. And with that, we'll jump into questions. Again, the feedback link here, tinyurl.com/RSM professionals feedback. That's the direct link to respond to the survey. If I mentioned this at the top of the webinar and a couple of places throughout, but The institutions don't endorse, we do not endorse, recommend, or promote any individuals or products. The information that you saw tonight and that we'll cover in the Q&A section is being presented in this webinar for educational purposes only. Again, would reiterate that if you have any specific investment guidance or advice that you're seeking, to talk to your investment professional specifically, because they'll have the most context of your investment needs, circumstances, objectives, etc. And if for some reason you don't have a financial professional available to you, you can also send an email to this email address, rsp.epb.usa@gmail.com, and we can work with you to help connect you with a financial consultant that way as well. So with that, I think we'll just handle a couple of the easy breezy logistics questions first. The webinar tonight, as I mentioned, is recorded. It will be, a link for the webinar will be available on the AICC, Austin Smiley Chamber of Commerce website, which is the same location, by the way, for all of our Money Matters webinars as well. So, whether it was the Fund with Fundamentals, Fund with Funds webinar we did, Investment Fundamentals, or even Budget and Savings. And as I'm looking through some of the questions here, I'll just mention quickly, for example, there was a question around savings accounts, right? And interest rates on savings accounts. We actually covered that in the savings webinar that we did in April of last year. So feel free to look at that resource. And there's actually some tools and calculators provided in that webinar as well. So hopefully the folks who asked those types of questions have an opportunity to go through the AICC website and pull up those webinars. Awesome. So the next question that I wanted to make sure we want to tackle here, and Ismet, I'm going to pick on you for this one if that's okay. And the question is, what would you recommend generally for contribution order, right? So get to 401k match, then contribute to an IRA, or max out 401k annual contribution and then contribute to IRAs. Ismet, you're on mute, by the way.
All right, my speaker was making noises, so I muted it and forgot about that. Sorry about that. All right, so good question. I covered it a little bit during my presentation. So it all depends on how much a person has and what their tax bracket looks like. So if somebody's making $250,000, they're not going to qualify for a deductible IRA, nor will they qualify for a Roth IRA. So then the answer is simple. Then they qualify for a 401k, because in 401k, yes, there's a contribution limit, but there's no income limit. And then with the HSA, also true, no contribution limit, but no income limit. So if that's the case, if the income is way too high, they only qualify. On the other hand, if the person is on the cusp of, income tax bracket, and the employer has no match or has no 401k available, then naturally they should go for a regular IRA for their spouse and themselves. And if they're under the age of 50, they could put away $12,000. If they're over the age of 50, that's $14,000. So I wish there was an answer in which order it would go into. If there's a match, 100% up to the match. So if the match is up to 6% of your contribution, put that 6% of your income so you get the match. And then after that, it's customized. There's no one size fit answer that I could give you. And it's a dynamic answer, because 1 year their income could be under the contribution limit. The next year it could be over. So it's constantly changing. So it needs to be reviewed. But hopefully that satisfies a generic. Always 401k first. The younger the person, and if they qualify for both IRA and Roth, then they do Roth first because it grows tax-free. And forget about, well, I have to pay tax on it now, because you have to pay tax on everything someday anyways. Let it grow tax-free. The longer the time frame, I would say 10 years plus. If you have 10 years plus, always shoot for the Roth first and then the IRA.
Excellent. And just a follow-up question on that. a little more detailed, but if an employer provides 401k matching, does that apply to both Roth and the traditional 401k?
So if they will employer, let's take somebody making $100,000 and they are allowed to put away $19,500, but the employer only matches the first 6% of their income. So the employee is putting away the whole $19,500. And I've never seen a 401k in my profession as of yet, including my own company, where all of my contribution would go into a Roth. I'm allowed 50-50. So I do 50% my Roth, 50% the regular. I don't get the deduction on my Roth, but I get the deduction on my other. So my employer match can only go into the pre-tax because they want to get their deduction. So their match will only go into the pre-tax bucket.
Excellent. Next question, Smith, one more for you, and I promise, Leah, we'll get you next. But there's a question specifically around benefits, retirement benefits for spouses, and then and also divorce benefits.
Right.
From SSI specifically.
Right. So from Social Security income, I touched upon that briefly, but I forgot about the divorcee comment. So a widower, male or female, as long as they were married for 9 months or more to their spouse, they can qualify for spousal benefit, especially if theirs was lower. So let's say he or she, the surviving spouse, qualifies on their own merit for $700 a month, but the deceased spouse benefit was $2,000 a month. As long as the person was married to the deceased person for 9 months or more, the living spouse can now go and apply for that. In fact, the 9-month limit could also be waived if challenged, if the spouse died in an accident. And very few people know that. So if the spouse dies in an accident, God forbid they were newly married, 5-6 months into it, he was deceased. If it's an accident, the surviving spouse can collect the benefit full benefit. As far as divorces, the spouse has to be married to the working spouse for 10 years or more. And of course, these benefits are beneficial, assuming that the collecting spouse who's claiming now, their own benefit wasn't as high as the person that they were divorced from. But the divorce is 10 years, the widow allowance is 9 months. And same, the other thing about divorce is that the spouse has to be collecting. So let's say, the non-working spouse is ready to collect at 62, but the person whose benefit they're collecting, he or she is not collecting his or her benefit until the age of 70, then she or he cannot collect until the person started collecting their benefit. Vice versa, if they start collecting at 62, then they may have to tweak their number. But the best answers to get customized is to go on that ssa.gov website that we mentioned, and also to have a visit, sit down. Social Security Administration will actually sit down with the person, give them the advice, show them the computer, show them what they have, and they give pretty decent advice. Sometimes, however, I've seen that my clients will go to one person, come back, and I would say, nope, that doesn't sound right. They'll go back to another person and they'll get the right information. So you may have to work with a couple different professionals, but always do your own homework first, because no one will look out for your benefit as you would, obviously. So the first thing to do is to go on ssa.gov, start searching there. When the time comes, maybe a year or two before, and before that you're ready to collect, then have a sit-down meeting with the SSI person as well as your financial planner.
Excellent. Excellent. So you mentioned a website in there. I know that there were a couple of websites that we mentioned during tonight's call. If it's okay, Ismet, can you just repeat the URLs, and Azra from our team can also just type them into the chat for everyone as well. But ssa.gov.
ssa.gov.
Right?
And then go into it and it says create an account. So create an account, login, password, write it down somewhere. Make sure not anybody can get into it. No changes can be made there. Like you can't go in and start collecting for somebody or anything, but it's just better to protect your information. So password protected, and periodically go into it and look at it. There are also benefits in there listed. God forbid a working spouse passed away. There are, if you have kids, there are benefits for children, as well as for the widow, widow or widower. The other website I mentioned was www.irs.gov. One of the specific publication I mentioned, if memory serves me right, I believe it was publication number 504. That was on the, I believe on Hsa. Ali, I think you had entered that in there. So if you can correct me if I'm wrong.
That's right. That's 504. That's right.
Publication 504, and it was irs.gov. And that's a very, very good website, because it's straight from the horse's mouth. You go in the search bar, put in anything: SEP, simple, 401k, IRAs, conversion, Roth conversions. You can put it in there, and it'll give you enough information that you may need specifically when it comes to IRAs or 401k rollovers. Pretty much every topic that we talked about today, it should be on there.
Excellent. So we've got time for 2 more questions, but just a general reminder for everyone, Azra was kind enough to post the link to the survey in the Zoom chat as well. So if you, before you leave tonight, just go ahead and take a minute to fill out a couple questions for us. That survey feedback is super important for us as we kind of plan out what the next kind of webinars will be in this series. Excellent. So Aliyah, the next one's for you. This is a fun one. One I'm sure you've probably seen several times too. But the question is related to inflation assumptions when you're thinking about your retirement goal and retirement plan. And the specific question is, how does one factor in inflation when retirement planning?
Wonderful. Yeah. So I know many people haven't played around with their company's tools. So if you're a Schwab customer or a Fidelity customer or a Merrill customer or any financial institutions customers, they have wonderful tools built out where they're basically like calculators or widgets or solvers or optimizers, whatever name you want to give them. So make sure you've explored those, because most of those calculators take inflation as an assumption into account when projecting out your expenses and your incomes and assets, and they do this all behind the scenes. But if you wanted, they even allow you to plug in what your inflation concerns are when coming up with your retirement goal and that plan. And the other portion of inflation that I'll mention as it pertains to retirement is if you, let's say you didn't want to invest and you kept everything all in cash, that would be very dangerous, because that wouldn't hedge your portfolio against inflation for retirement, because the cash return, which is almost nothing, wouldn't be able, like inflation would end up outpacing the return on your all cash portfolio. So that's why it's important to be invested, period. But now it's just a matter of how far away you are from retirement and making sure you're not over-invested or under-invested. So you always want to be invested. It's just a matter of where on that spectrum you are to make sure that inflation from that perspective is also taken care of.
Excellent. Thanks, Aliyah. Super helpful. Again, just we can't emphasize enough that your employer probably has a lot more tools than are being taken advantage of by your colleagues. So it's a great opportunity to just even explore, even ask HR. Right? It's a great opportunity to just ping HR and ask, like, hey, how do I get access to this information? There are even companies that offer benefits to give you access to a planner, right? A financial planner included with your with your investment options for retirement. Awesome. So we've got time for our last question here. It's a bit related here, and then we'll dive into our last slide. So the question, Ismet, I'm going to ping you on this one. For somebody who is self-employed, you could elect to set up either a SEP IRA, or you could put it in so that you can put higher amounts into that account. What would you advise for that individual?
So pros and cons of a SEP plan, it depends on how big the company is. If an employer has, say, even 10 employees, 5 employees, anything more than themselves or their spouse. So say a person has 10 employees, themselves, their spouse, and 8 other employees. A self-employed business owner effectively can put away as much as 25% of his or his net income in the SEP IRA, not to exceed $58,000. That's a huge, right? That's a huge number. But if they're putting away 25% for themselves, they have to put 25% away for every other employee as well. So that's the negatives, pros and cons. Pro is that, you can put away 58,000. So if it's a sole proprietorship and all the employees are 1099 employees and not your W-2 employees, great, do that. And if you don't have that, maybe you have 3 employees, yourself, your spouse, and 1 other person, maybe an outside salesperson. I advise my clients to say, you know what, this 3rd person, why don't you put away $100,000 for you and your spouse? Make the other person a 1099 employee, and then you don't have to contribute for them. Or because you're saving so much money by putting away $116,000, it's worth it to put, if he or she's making, let's say $50,000 and you're putting away 25% for them, that 25% is $12,000, but you're saving, so much money in your own tax bracket. So it all depends. But yes, the limit is definitely higher. The other, and here, the reason why it can become a negative is because, like a 401k, we have to contribute to get a match. If we don't contribute, the employer has no expense. SEP plan, however, whether I as an employee contribute or not, my employer has to give me that money and I don't have to put in the match. However, if I do a simple plan, which is a much lower limit, I can look that up. A simple plan limit for 2021 is lower. Let me see what it got changed to. That limit this year is $13,500 or $16,500 if over 50. So same example, employer's wife or spouse, 8 employees. Employer decides to put away his $16,500 if he's over 50 or she, and then same for the spouse. If the 8 employees don't contribute, they don't have to put in any money for the employees. Only
Great.
if the employee contributes, then the employer, the owner, has to match. So that maybe is somewhere in between that you could do.
Excellent. Thanks for that, Ismet.
Sure.
So with that, I just wanted to again kind of thank everyone for their time tonight. Hopefully this 2 hours was well spent for you, and the first time investment into what will hopefully be a continued investment into each of your retirements. A couple of quick things I'll just mention logistics wise. Again, the survey link is in the Zoom chat. Again, really would love your feedback. This webinar tonight, as well as our previous Money Matters webinars, as well as the Retirement Savings Plan webinars earlier this month, and the articles that were written in honor of RSP are all available on the Smiley USA website. And the links for all of these webinars are also on the Smiley USA website, as well as the AICC website. So with that, I just wanted to once again thank our presenters and thank the National Economic Planning Board for helping put this on for us. And thank you all again for taking the time with us tonight. We're looking forward to seeing the survey responses as well as any of the individual questions that came through email. And with that, I'll leave you with one quick joke that you're probably seeing on your screen. But if nothing else, please don't think of the 401k as a marathon. Even though it may take a long time to invest into it, I promise it's a lot easier than running outside in a race. With that, have a great night, everyone. Yalimada, and thanks again. Bye.
Thank you, Yali.